Hello and welcome back to The Note. Well, we had refreshingly little drama from the ECB this week, if you don't count the very dramatic demonstration that started their press conference. It seems that the course is set and that we have QE at least through until September of next year. Now, is QE working? How will we tell if it does? And are there really green shoots beginning to appear in the eurozone economy? With me now to discuss this is the chief European economist from Goldman Sachs, Huw Pill. Huw, thanks for joining me once again. Let's start by taking a look at the ECB lending standards survey, where they talk to commercial banks. Plainly a very important question in terms of whether you can get the motor of growth started once more in Europe. This looks moderately encouraging, is it?
I think so. I think we are seeing a cyclical recovery in Europe. I think that's being driven by a number of factors, of which QE is certainly one, but perhaps not necessarily the most important one thus far. But an important driver of that cyclical recovery is an improvement of financial conditions, one symptom of which, one representation of which, is this improvement in credit standards for the banking system. Well, certainly they've got to a situation where the reluctance to lend is no longer a constraint, which was certainly the case post-Lehman and in the middle of the sovereign crisis. I think we've got to a situation where the lack of lending is more coming from a lack of demand thus far, rather than from a supply constraint on the side of the bank.
Takes us nicely to the next chart, which takes a look at the same survey on demand, where again, obviously, we're not resurgent, but we are improving quite significantly again, if we believe those numbers.
I think that's right. We are seeing a recovery in demand, particularly on the business side. The increase in demand for loans tends to follow the improvement of activity rather than lead it.
Right.
And because we've seen a pickup in the economy over the last 12 months or so, and that's beginning to accelerate in our view now, we would expect to see loan dynamics to pick up through the middle of this year.
Okay, so if we are beginning to see a recovery anywhere, maybe that raises the issue of why did we need to resort to QE. If we take a look at this chart, which shows you five-year forwards, one of the favourite central banking measures of long-term inflation expectations, was it really a response to this very dramatic deflation scare we had towards the end of last year? And what is the story behind this chart? Why are people still evidently so worried about outright deflation or lowflation?
Well, I think QE was triggered by the developments in this type of indicator, and I think Mr. Draghi and his colleagues did become concerned in the middle of last year about the threat of a de-anchoring of inflation expectations away from their target. And the threat of some sort of self-fulfilling dynamic emerging, where people expected lower inflation, set lower prices and lower wages as a result, and that validated the expectations of lower inflation.
Can we say we've averted that cycle yet, though?
Well, I think QE and the resolution shown by the ECB, some of whom doubted that, some people doubting that they would show such strong resolution, I think that has, as you can see, helped to halt this decline in inflation expectations. But nonetheless, there's no real sign yet that we've seen a reversal in the decline of inflation expectations. Yesterday, at his press conference, Mr. Draghi was at pains to point out that in order to stop this more aggressive policy, he would need to see a sustained rise in inflation towards levels that are more consistent with the objective. And even though longer-term inflation expectations have picked up at the margin, there's no real evidence yet of this sustained rise. And then that's an important reason why we think, at least, he will certainly continue purchasing
beyond September next year.
Well, certainly through to September next year, unless we see moves in this indicator and indeed in a broader set of indicators that would point to the sustained rise. I think the balance of probabilities that he'll do more rather than less.
One final question, I guess. The bond market in Europe is much less important than it is in the US in relative terms. Is this going to damage bond market liquidity? Are they going to have enough bonds that they can buy? Is QE the right policy to try to get this line back up above 2%?
Right. Well, I think QE does help improve financial transmission and financial conditions, at the margin at least. So it's certainly moving in the right direction. I think it'll always be difficult to work out the magnitude of those effects. I mean, certainly bond markets are being drained through the purchases by central banks. And I mean, the very low level now we see in German long-term rates, and the potential for some functioning issues in those markets, I think things that the ECB will show increasing concern about and probably will need to take measures to address. But I think, more broadly looking into the future, the key issue will be, can Mr. Draghi and his colleagues convince people and convince the markets that we are seeing a recovery, we are seeing, therefore, stronger growth expectations, stronger inflation expectations. And if those fundamental drivers are credible, they'll lead to a steepening of the yield curve. And that will encourage people both to sell their bonds and indeed make more of the outstanding bonds eligible for purchases by the ECB under the restrictions it's imposed on itself. So It's the recovery that will enable them to complete the QE as much as it is that the QE will drive the recovery.
Okay, Huw, thank you very much indeed. It sounds as though there is a possibility that we do indeed move from a vicious circle to a virtuous circle. I suppose for the markets, the bottom line will be, yes, there are some green shoots, which is good, and yes, we're going to get QE for quite a lot longer, which is good. So you can see why people are still viewing European markets much more positively.